we're at the beginning of the ESG data wars. What does this mean for the industry? There's more and more data coming onto the market, more and more information that's tremendously useful if only you can process it. And so analytics firms, data generators like the exchanges, financial information providers like Refinitiv and others are all struggling to solve this question.
There are trillions of dollars flooding into the ESG investment space. The number of firms that have built out data infrastructures to aggregate and analyze ESG-related information has exploded. They're all rushing to reach economies of scale and develop distribution capabilities to claim their share of the market for ESG data. I spoke with Will Trout about his new report on ESG in portfolio management, how discrete client stock restrictions are slowly being replaced by an integrated approach, and a whole lot more on this episode of the Wealth Management Today podcast. So great to have you here with me in the wonderful world of wealth tech. And you're listening to episode 67 of the Wealth Management Today podcast. I'm your host, Craig Iskowitz. I run a consulting firm called Ezra Group. We're experts in everything related to wealth tech and wealth tech strategy, wealth tech operations. We deliver growth-oriented solutions to banks, broker-dealers, asset managers, RIA aggregators, as well as all those wealth tech providers out there through our premium advice and targeted market research. On this podcast, I speak with some of the smartest people in the industry who are on the leading edge of technology and innovation. And before we start the episode, please subscribe to this podcast on iTunes or Spotify or wherever you listen to your podcasts, and leave us a 5-star review. It'll really help, and I appreciate it. Thanks. And I'm happy to introduce my next guest on the podcast is Will Trout, Head of Wealth Management at Celent. Will, what's going on, man?
Hey, Craig. Good to see you again.
It's good to see you as well. Since we don't have any conferences to go to, we don't see each other as much as we used to see each other.
I know. I have the buffet all to myself.
And you have the buffet to yourself and no more running. We used to get to go running in the morning when whatever city we were in, along whatever places we were. That was always fun. So we'll have to figure out how to do that again. But this podcast, we're talking about a new report that Celent just put out, that you just put out, part of Celent. It's called ESG in Portfolio Management, From Data to Deployment. And before we do that, can you give us a quick 30-second elevator pitch for Celent?
Sure thing, Craig. I'll give you the 15-second version. So Celent is a division of Oliver Wyman. We're the research and advisory arm of the business, and our focus is the intersection of strategy and technology in financial services. I head the wealth management practice.
Excellent. So let's talk about the report. Let's just dive right in. ESG in portfolio management, from data to deployment. So ESG is a big hot topic. Everyone's interested in it. We've done a couple podcasts on different aspects of it. And some of the key points pulled out of the report, the money's flowing. There's this huge amounts of assets flowing into ESG. What are you seeing there?
Well, yeah, I mean, ESG is exploding in terms of the asset flow. So several observers have estimated sort of ESG-driven investments as totaling more than $30 trillion. That was 2 years ago. That was in 2018. Today, we're approaching $50 trillion and should reach 53 by the end of 2021. So, whether you talk about funds or managed accounts or other types of investments, you're seeing an explosion of interest in the topic. And I think, a lot of people understand ESG, environmental, social governance criteria, as mostly E, so environment or sustainability, but obviously with the social tensions and governance issues that have emerged in recent years, you're seeing a broader adoption of those criteria for investment decision making.
I want to focus on a couple parts of the report that I think will be more interesting to our audience. And we work with a lot of broker dealers, banks, asset managers, and implementing systems and building software around managed accounts, fee-based advisory platforms. So I was really interested in the section you have on screening versus integration. And I didn't know what you meant by those terms. Can you explain what you mean by screening versus integration in terms of ESG?
A great question, Craig. And so screening, I think everyone understands sort of at an intuitive level, right? You might say restrictions, or you can screen out an entire sector, say oil and gas, for example, or you can screen out individual companies, ExxonMobil, that have a heavy carbon footprint. Integration, on the other hand, is a more holistic, wide lens approach where you're basically taking into account ESG criteria from the very beginning of the investments process. And so you've seen BlackRock, for example, announce that all investments are going to be ESG driven, or rather their actively managed funds are going to be ESG driven from 2021 onward. And UBS just announced something similar. I think what investors and what portfolio managers are doing is adopting a more sophisticated approach to investing. So, ExxonMobil actually may be a great fit for your portfolio, and they're, they have a carbon footprint to be sure, but they're doing a lot of social good and positive actions from other standpoints, perhaps. And do you want to restrict your portfolio in a way that will lead to underperformance? That's a big difference. The integrated approach does not assume any sacrifice of returns, whereas the screening approach says, hey, we're going to screen out this company, and if it damages returns, well, that's part of the game.
Exactly. That's when we always did screening. I mean, on all the systems we built or helped design for custodians or broker dealers, there was always a restrictions part of the managed account process where you block out different groups of stocks, either getting a feed from a vendor that said, here's our list of stocks where you can block oil and gas or weapons or energy or at different levels or specific stocks. Whereas now, but that, as you said before, that was you were willing to underperform if tobacco stocks outperform because you didn't want them. But with the integrated approach, that doesn't happen.
Yeah, I mean, the screening method is a pretty blunt tool. It's sort of the hammer approach, Craig, whereas with the integrated approach, you're really looking at the whole portfolio. And so you're not being as black and white in terms of your decision. You're going to see where the portfolio sits, from a broad perspective, and not restrict or exclude any particular firm or actor, from the get-go.
So would this be, if you're looking at the technology part, like a wealth management platform vendor, they wouldn't be dealing with integration that comes from the asset manager?
Well, a lot of the business is funds, still mutual funds or ETFs, and so if you're looking at those products or individual securities, it is possible to screen out, as firms have been doing for years, sectors or individual securities. It's really about, as I talk in the report, rebalancing software allows you to get granular in terms of the holdings. And so, that might be part of a trading platform, or that might be self-standing rebalancing traction. There are a number of ways to slice that.
That's something we see a lot. We have a number of clients who offer rebalancing software, and I know they're always looking for differentiators. And I think this could be something they could offer that would help their clients deliver better results to their clients.
Well, absolutely. And you've seen the growth of direct indexing, right? That's a recent phenomenon. And you have a number of vendors playing in that space, the ability to do that. is powerful, and you can customize those indexes, those direct indexes, to reflect ESG criteria as well.
Yeah,
so rebalancing software is a great weapon here. Mm-hmm.
Yeah, the direct indexing has taken off. The number of vendors is, 20 years ago or 15 years ago, it was only one or two. Even 5 years ago, there was very few. Now there seems to be 20 or so firms that are supporting direct indexing, from custodians to TAMPs and other vendors. But I think the rise of fractional shares really facilitated that, didn't it?
Well, that's right. Zero commissions and fractional shares allow you to build an index portfolio, ESG centric or not, for a fraction of the cost. You would have to build that stock by stock yourself. And so that's all part of the democratization of investing, a trend that, extends from sort of the Robin Hoods of the world to, more sophisticated providers, including family offices that are really eager to offer an entry point, say, for younger investors, or otherwise reduce the minimum needed for entry. So just like rebalancing software and UMA has become democratized, fractional shares have allowed the construction of portfolios to a range of criteria that simply would have required millions of dollars to construct back in the day. And you had Natexis and Aperio and firms like that doing it, Parametric as well. Now, as you say, you've got practically dozens of firms with these capabilities.
Sure. Orion announced fractional shares, one of the bigger RIA broker-dealer technology platforms. I know a lot of other firms are looking into it.
Even in alternatives and illiquids, like you can buy a share of a 1928 Rolls Royce, right? If it's securitized somehow. So you no longer need to have $3,000 to get equity in Amazon, for example. You can get a fractional share.
That's the old days, right? Well, even less. You can buy odd lots. You remember when you couldn't buy odd lots, or it would cost a lot more to buy that. You had to buy in round lots of 100. Now people can still buy one share, but the democratization, as I see it, is when the fractional shares came out, that you could buy $100 worth of the S&P, not just buying a fund, but buying an actual group of stocks and owning shares of that at that level. So, but one of the biggest parts of that is tax optimization. And on a wealth front, was one of the first robos to offer that, where they believe they can generate tax alpha for even the smallest clients in a taxable account.
That's right. I remember when they launched their direct indexing proposition, and you've seen others follow. So the ability to build around concentrated positions, to generate tax alpha, to incorporate social criteria or environmental social governance criteria are all present huge upside.
I wanted to move on to another part of the report, and it's the data requirements and what we call it's the figure 5 ESG marketplace and data flow. And I'll share this. I'll put this on the screen on the video of the podcast. People can see, and I'll put it on Twitter so people can see this diagram. But it's a diagram that shows left to right the data flow in ESG, where you have data generators on the left, and a bunch of logos of different companies, and then into the trading risk management vendors, into the alternative data providers, into analytics, into the buy side. Can you kind of explain how this diagram works?
Yeah, sure. Well, there have been a number of articles in the general media on the rise of the exchanges. They were once clubby, sort of quiet backwater organizations. Now they're global financial institutions that are generating data. They're distributing that data to the asset managers or even wealth managers on the buy side, and they're also analyzing the data, producing analytics. And you have in that category of data generators not just the exchanges who are really the vertically integrated providers of data, generate the data and distribute it downstream. You also have firms like Refinitiv, you have firms like Morningstar that Bloomberg that produce, analyze, and distribute data. What has happened in the market, however, is that there's been the emergence of all these really cool next generation analytics firms. You know, you've got Owl Analytics, you've got True Value Labs, Arabesque, firms like that are solving a problem in the marketplace. They're providing asset and wealth managers with derived data. In other words, not just the raw data, but analysis based on that data that the asset and wealth manager can consume in a quick and immediate fashion. And so there's a titanic struggle going on. Who owns the data, right? Data is an asset. Who owns that data asset? Who distributes that data asset? And even what I would call data mastery or taxonomy, like how is this data structured? Via knowledge graphs, for example, which Refinitiv has done, which AWS has done with Neptune. This is a huge deal because if you're able to classify or dictate how the data is structured, you have huge control and you can analyze it in new ways and distribute it to the end consumer as a one-stop shop. So we're seeing a lot of interest from the cloud providers, Microsoft, AWS, Google, and others, in basically, finally getting to that point where they can monetize data as an asset, ESG data as an asset, by generating it, slicing and dicing it, and distributing it to the buy side. So I call this the data wars, Craig. And right now the exchanges enjoy a privileged position in that they control the data flow, but there are a lot of new entrants very hungry for part of that game.
One thing you mentioned was knowledge graphs. So I have a degree in computer science, so I think of it in terms of the computer science knowledge graph of a data model, but I think you're referring to something different. What do you mean when you say a knowledge graph? Sure.
I mean, I would describe it simply as something akin to LinkedIn, where every piece of data is linked to another piece of data. And so there's coherence in the larger data set. Whereas, you look at a traditional database or data storage structure, you have all these different data points that are unrelated. In a knowledge graph, you have a structure of the data where every piece of data is connected to another piece of data, which is connected to another piece of data. And what that, just like LinkedIn, right, a network effect, and what that means is you cannot just throw in more data into the architecture, into the data storage. It actually needs to be connected or linked to another piece. And that gives the data real structure and coherence and power in terms of the logic and how that data can be used. So it's a tremendously powerful tool for analytics, as anyone who has used LinkedIn or Facebook is quite aware.
Your point about data is well taken, and we've seen data being an important part of wealth management business and wealth management technology for quite some time. Will this become a problem with these firms, and if these firms own the data? Will that drive up costs? Will there be, we say, a data war? Firms saying, well, you don't have this data, we're not going to give you access to it because it belongs to our proprietary universe? Or is this something that's all going to level out where the difference between a Refinitiv or an MSCI or an SP Global won't be that big of a deal?
That's a great question, Craig. And actually, I think we're at the beginning of the data wars rather than at the conclusion. First of all, there's the emergence of all new types of data, whether it's satellites pulling data from the proverbial Walmart parking lot, or data from the Internet of Things. How hard you put your foot on the brake, for example, used for insurance assessments. There's also a huge disparity among the ratings and other forms of evaluations delivered by these data providers. So I call that comparability. So Refinitiv's ratings are not necessarily the same as Sustainalytics or those of ISS. And so as a consumer, you're faced with a conundrum. Not only do you have different ratings or grades assigned to the investments you're looking at, but you're not necessarily even sure how these ratings were derived, or the methodology may be confusing, or you may have trouble actually using them in a practical or actionable way. that's why many firms on the buy side, wealth and asset managers, are looking to raw data, data straight from the satellite or data straight from a report issued by the company, or whatever the case may be. The problem is, how do you consume that data? So there's this entire level of analytics that represents the growth area of this business. I think it'll be awfully hard in short, Craig, to corner the market on data.
The Invest in Others Charitable Foundation recognizes individual advisors and firms that are making a difference by donating their time and money to causes that they care about. The Invest in Others Foundation builds critical visibility, encourages others to get involved, and channels additional resources to those in need, and highlights the important work being championed by the financial services community. I volunteer with Invest in Others and help them out where I can. I'm also on some of the judging panels, and this is the awards week. Normally it's held in person in a big gala up in Boston, but can't do it now with COVID. So it's all virtual, and this week they're announcing the winners in all their categories. Categories include Catalysts, Community Service, Global Impact, Volunteer of the Year, which should be today, September 24th, when this podcast drops, and then tomorrow, the day after this podcast drops, depending on when you're listening, is the Lifetime Achievement Award. You can go to investinothers.org and watch the award presentations, and please specifically donate to this great cause. I would really appreciate it. Indeed, there's always more data. I guess the question is it compatible, and do people understand that? So when they see a rating that this company is good on ESG, whatever the number is, how Refinitiv defines it, or we've talked to a couple other firms, Act Analytics, and all these MSCI, and the other different firms that are creating these data sets. That if there's I think a misunderstanding at the other end, whether it's investors or CIOs or people who are consuming it, to know that when Refinitiv says these guys are good, or when you're doing a screen and here's all the levers you can pull to get firms that you think are good, you might get a completely different set if you go to MSCI or you go to S&P Global, right? So you're saying you can get a completely different screen of firms using the same criteria based on the underlying data.
Well, that's right. And then I would even take that further and say, what percentage of that data is actually being provided by the company that's being profiled by, ExxonMobil, to use that example again, or BP or whomever. What is basically, from the corporate report, and is that relevant, or is that going to be what's sometimes been called greenwashing, right? Efforts to virtue signal. So there's real questions about, what goes in the soup, and whether your soup is comparable to someone else's, and that's hard. And then, that's actually why firms are using things like controversy ratings, like how often does your company appear in the news, and in what sense? Because a lot of the ratings are by definition, the traditional ratings are actually fairly static, right? They rely on information that's months old. And so how do you get a real-time update in a way that helps you manage your portfolio? That's a million-dollar question.
Or billion-dollar question, depending, right?
Or trillion, as we say in the report. That's right.
And I want to, before we're done, we're running out of time, I really wanted to touch on the implementation part of your report, which I find the most interesting. That's the part that my company, Ezra Group, gets involved in a lot, which is how these tools and technologies and data get actually run by enterprises. Can you talk a little bit about the roles and the workflow of ESG as you have it defined and implementation in your report?
Absolutely. I divide portfolio management from an ESG perspective into three broad categories. There's customization. We talked about that before, the ability to create bespoke portfolios. That's really not economics for most firms, or it hasn't been until the onset of fractional shares. But you have family offices, you have sovereign wealth funds, these type of firms creating portfolios from scratch that reflect their unique criteria. More common is going to be an SMA, or managed account, whereby you're buying the intellectual capital of a third-party asset manager, and you're managing this intellectual capital or models via some sort of coordinating technology, rebalancing other. Basically, you're accessing the best in breed funds and security selection processes out there on the market. Lastly, and perhaps most interestingly, is direct indexing. In the ESG context, that would be modified direct indexing, recreating an index, ESG or SPX, S&P 500, but then customizing the individual holdings to the criteria of the investor or to an ESG-based lens. And as we've talked about, that's been made a lot easier by the arrival of fractional shares and zero commissions if you're no longer worried about incurring costs, and you can fine-tune your investment decisions to capture, say, a tenth of a share of an Amazon or whomever. You can really deliver that kind of customization, and with modern technology, deliver it at scale. That's a very powerful proposition, Craig.
Indeed. And that's the one thing a lot of our enterprise clients want. They want to be able to deliver any solution at scale. That's the whole point. If you've got a great solution, but it doesn't scale well, then you're not going to be profitable. And the other part of your implementation was specifically about managed accounts. And that's something we deal with a lot, fee-based advisory platforms and managed accounts. And the portfolio structures for ESG, I thought that was interesting, and how that's different scalability, customizability between the different portfolios. Can you talk about that a little bit?
Sure. Tell me where you'd like me to focus, because there's a lot there, Craig.
Well, just talk about the index replication maybe in the models.
Yeah. Essentially, if you're able to access models of multiple managers, you can draw in all different types of products. You can bring in funds. You can bring in ETFs, individual securities, fixed income, and you're able to slice and dice at a pretty fine level using fractional shares. You can really build out a diverse and ESG-centered portfolio in a way, and using automated rebalancing, have it updated on a very frequent basis. Of course, that'll require some operational agility, right? If you're using actively managed models, you're going to need to rebalance often. But lower transaction costs and the ability to take positions on a fractional basis really enable that agility. And for those firms that invest in technology or that develop technology for wealth managers, they're quite aware that nimbleness and the ability to manage exceptions and build around existing positions and do it at scale has truly become the holy grail. So breaking the trade-off between customization and scale is today's reality, and I'm excited to see where we go from here.
I'm really excited, and we're out of time. I mean, where we go from here, there's so much. The world is kind of our oyster on this, and we're really at the very beginning, as you said earlier, rather than even the middle of the whole ESG trend. And I'm really interested in this report. There's a lot to dig into. I'm going to share a couple of the slides in the video for people who are going to watch it on YouTube, and we'll put it on to Twitter, a couple pieces of it for people who are going to listen to the podcast. And Will, thanks. Always a pleasure to talk to you. Very informative, and look forward to seeing more stuff out of you guys at Celent.
Thank you, Craig.
Hey, it's Craig again. Another fantastic episode is in the can. My top 3 takeaways were $53 trillion in ESG investments by 2021, which is up from $30 trillion in 2018. That's a 77% increase. Restrictions or screening out specific stock sectors has been morphed into the integration of ESG inside of the investment process of asset managers. And finally, ESG data wars, with providers like Refinitiv, Morningstar, and FactSet all battling it out like a UFC steel cage match for dominance in this hot investing category. Please drop what you're doing and leave us a 5-star review on iTunes, and share a link to this episode on your social media networks. Talk to you all again next time.